What is a penny stock? A penny stock is a share in a very small company that trades at a very low price. In the UK, that usually means shares worth less than £1. In the US, it's often under $5. The name penny stock comes from the idea that these shares are worth only pennies compared to the big, famous companies you've probably heard of. Unlike large established businesses such as Tesco or Microsoft, penny stock companies are often startups, struggling businesses, or firms that simply haven't grown much yet. Buying a penny stock means you own a little slice of that smaller company, but at a much lower cost than buying shares in the giants of the stock market. It's also worth noting that many penny stocks don't trade on the big, well-known stock exchanges. Instead, they're often found on smaller markets with lighter rules and less oversight, which also makes them riskier. Why does it matter? Penny stocks matter because they attract a lot of attention from new investors. At first glance, they look appealing. The price is low, so it feels like you can buy more shares for the same amount of money. People often imagine, if this company takes off, I'll be sitting on a fortune. There's also an emotional side. Penny stocks give people the sense of being part of a hidden opportunity, spotting a company before anyone else notices. It's a bit like discovering an unsigned band before they become famous. The idea that you could get in early and benefit if the company grows is exciting, but here's the misconception. Cheap doesn't always mean good value. A share priced at 50p isn't necessarily a bargain compared to a share priced at £50. The price itself doesn't tell you whether the company is strong or weak, or even how much the underlying company is worth. Penny stocks also matter because of the risk. These small companies often have limited resources, unpredictable earnings, and far less stability. That's why their prices can rise or fall very dramatically, sometimes in a single day. Here's a simple example. Let's say you find a small company with shares selling for 20p each. You decide to spend £100, which buys you 500 shares. Now, if the share price doubles to 40p, your £100 is suddenly worth £200. That's a 100% gain, which feels incredible. Few big company shares move that dramatically in such a short time. But the opposite can also happen. If the share price falls to 10p, your £100 instantly becomes £50. You've lost half your investment, and you might not be able to sell quickly if no one else wants to buy. This is why penny stocks are often described as high risk, high reward. What else should you know? There are a few key things worth keeping in mind. First, liquidity. That's a financial word for how easy it is to buy and sell shares. Big companies have lots of buyers and sellers every day, so it's easy to trade. Penny stocks often don't, meaning you might get stuck holding them because there aren't enough buyers. Second, volatility. This means how much the price moves around. Penny stocks can swing wildly, sometimes in a single day. This can be thrilling and exciting, but also stressful, and it makes planning much harder. Third, scams. Because penny stocks often fly under the radar, they're sometimes used in pump and dump schemes. This is when people hype up a stock online to drive up the price, then quickly sell, leaving new buyers with losses. It's one reason to be especially cautious about tips from strangers or flashy promises of quick riches. Finally, comparison. While penny stocks might feel exciting, bigger and more established companies, often called blue chip stocks, are generally more stable. They don't usually promise overnight riches, but they're far more reliable for long-term investing. To sum it all up, a penny stock is a cheap share in a very small company. They grab attention because they're affordable and carry the dream of striking it rich if the company grows. But they also come with big risks, unpredictable prices, fewer buyers and sellers, lighter regulation, and even the potential for scams. If you're curious about penny stocks, it's best to treat them with skepticism and more like speculation than a steady investment, closer to buying a lottery ticket than owning part of a strong business. They might pay off, but they could just as easily lose value quickly. The key is to approach them with caution and never risk more than you're willing to lose. Thanks for watching this video. Not sure where to go from here? You don't need another video, you need a plan. Grab the free 5-day series below and start investing with confidence. The link's right here on screen and in the description, don't miss out.